Okay, imagine opening your mail and finding a letter that's going to change your life forever. A letter that threatens to take your house, your personal assets and everything that you've worked for. Why? Because of a bounce back loan you took out during the pandemic. Yes. Now in today's video, I'm going to break this down exactly how UK banks have started to use the courts to wind up companies and come after directors personally. Now, if you're a director who took out a bounce back loan, this could be the most important video you watch this year, so stay tuned. Welcome back, Chris Worden, Director First, and this is where we make UK insolvency simple and easy to understand. If you enjoy my content, like, subscribe and turn the notifications on. Today's video is one of the most crucial because it deals with something that is affecting thousands upon thousands of UK business owners right now, and it's called the Forced Liquidation Pilot Scheme. Now what we're going to do, we're going to dive into how banks like Starling, Lloyds and Barclays are using court action to wind up companies that misuse bounce back loans. The red flags the banks are looking for to target company directors, and I'm going to give you some real life examples of directors losing the businesses and potentially the homes. And I'm also going to tell you what steps you can take to protect yourself if you're at risk. But let's get started. Listen, this is a serious topic, and anyone who took a bounce back loan that perhaps took it in the wrong manner and spent it on the wrong things, you need to understand this. So we're going to start with the basics. What is the forced liquidation scheme? Okay, during the pandemic, millions of UK businesses took out bounce back loans. They were designed to help them survive the economic shutdown. Now, years later, some directors who overstated their turnover or used the money improperly are facing serious consequences. The government, with support from the likes of Rachel Reeves, have rolled out this pilot scheme that's encouraging banks to take action. Now there's 3 banks at the moment, Starling, Lloyds and Barclays. They are leading the charge. And here's how it works. The banks review the bounce back loan books for red flags. I'm going to come on to that a little bit later in the video. Now, if a company raises too many red flags, the bank's legal team files a winding up petition in the High Court. Okay, let's have a quick drink. A winding up petition is basically an application to court. You'll be informed of the winding up petition, and if you don't pay the money back that's owed, the petition's granted, the company's forced into liquidation. Okay? Once the company goes into compulsory liquidation, the bank can either collect on the remaining assets or sell the debt to a litigation funder. Dead important this, because these funders are absolutely ruthless. They will pursue a director personally, often threatening bankruptcy if debts aren't repaid. And with the prospect of losing their homes, many directors are ending up paying these debts quickly, often with their personal assets. Now this is dead important. Let's get into the part you've been waiting for. The red flags that the bank are looking for when deciding whether to take someone to court. Here is a detailed breakdown. Red flag number 1, not submitting company accounts. So failing to file annual accounts is one of the biggest red flags. It suggests that the company is either poorly managed or actively trying to hide something. Now, if you've fallen behind on your filings, this is going to put you straight in the danger zone. Number 2, no confirmation statements. A company is legally required to submit confirmation statements to the government annually. Now these statements confirm that your company's details such as directors, shareholders are correct. Banks view the failure to submit these as suspicious, and that raises concerns about potential fraud and negligence. Number 3, this is a biggie, a notice for strike-off. If a company receives a notice for strike-off from Companies House, it's a big alarm bell for the banks, because this means the company has been flagged for removal from the register, either due to inactivity or failure to file necessary paperwork. It's almost always blocked by creditors, especially the bank who lent you the bounce back loan, but it signals to the bank that something's wrong. Another thing banks are looking out for is a change of directors after receiving a bounce back loan. It's a huge red flag. If a company suddenly changes its directors after getting the bounce back loan, it signals to banks that there might have been something fraudulent going on. It suggests a kind of bait and switch, that the original director may have applied for the loan with the intention of walking away from the company straight afterwards. Another red flag is minimal or no repayment. If a company hasn't repaid a single penny or very little on their loan, it raises concerns. Lenders are looking at this as a sign of avoidance or financial mismanagement, and in cases where they believe the company has assets, this non-repayment is a key trigger for enforcement action. Another thing is ignore calls and letters from the lenders or the debt collectors. Now, communication in any type of creditor pressure is key. If a director consistently ignores attempts by lenders or debt collectors to resolve the debt, it paints a picture of either indifference or deliberate evasion. And this lack of cooperation is a green light for the banks to escalate the matter legally. Another big red flag is links to known bounce back loan fraudsters. Some directors unknowingly may have ties to individuals or entities already flagged for bounce back loan fraud. Banks are becoming more sophisticated in detecting these connections through shared addresses, names, or even business dealings. If you have any of these connections, you could become a target. Number 8, this is a massive one, and it's over-egging your turnover. It's probably the most common form of fraud associated with a bounce back loan. And just for those who don't know, the bounce back loan allowed businesses to claim up to 25% of their turnover in 2019 with a cap of 50 grand. There's loads of directors who exaggerated their turnover to qualify for larger loans. And if the bank sees that your declared turnover and your actual filings don't match, you're in trouble. 9, dormant accounts before or after a bounce back loan application. So another major red flag is when a company was dormant before applying for a bounce back loan or becomes dormant immediately after receiving the funds. It suggests that the company may have been reactivated solely to claim the loan without any intention of using it. If I get a call off a director or any of our team is, we'll ask for your company name, we're going to go on Company's House. Now, if your company was dormant in 19 and filed dormant accounts in 2020, we just come out with it. Listen, you shouldn't have took a loan. It's clear as day. You could only take a loan if you was trading at the start of 2020. And number 10, if the director has got any fraud markers against the name. So a CIFAS is the UK's fraud prevention service, and if a director has a marker against the name, it means they've been flagged for suspicious of fraudulent activity. Banks see this as a direct indicator of potential crime, and they are much likely to pursue court action. So let's now talk about the winding up petition itself and what happens if it's filed against the company. And here is a step-by-step breakdown. So the bank submits a petition to the High Court asking for your company to be closed down. It's a formal request to liquidate the business because it cannot pay its debts. There's a court hearing date set. If the petition is accepted, the court will schedule a hearing. You'll get notice of the date and you may be required to attend. The hearing date will also be published in the Gazette, meaning that creditors and the public will know about it. If the money isn't paid back, the court will issue a winding up order. If the judge agrees that your company can't pay its debts, they'll issue this winding up order, and this means your company is officially placed into compulsory liquidation. Then the official receiver is appointed, and once the order is made, it's the official receiver that takes control of the company, and they'll oversee the liquidation, sell off any company assets if there are any, and they'll also be looking very closely at your conduct as a director. Obviously, bank accounts will get frozen as soon as the winding up order is made, I mean, this can be a huge problem if you're still trading. The official receiver will try and sell off company assets. And if they're unable to get any assets from the business, they might look for you personally, especially if you've done something wrong with the bounce back loan. Now, if the official receiver discovers that you as a director failed to meet your legal duties and fiduciary duties, you could be disqualified from acting as a director for up to 15 years. Now, a real life example of this is a case of someone called Azmi Shafi Ahmed. Now, Mr. Ahmed ran a company called AZ Financials, and they applied for a bounce back loan of 50 grand, saying that the company's turnover were 200. In reality, his actual turnover was under 40. Worse still, instead of using the loan to support the business, he transferred it into his personal account just 3 days later. And as a result, his company was wound up and Mr. Ahmed was disqualified from acting as a director. He's just one of many directors facing severe consequences for misusing the bounce back loan. Now, you might be wondering, why aren't all banks going after bounce back loan defaulters like the three I mentioned? Interestingly, many lenders have been warned by the FCA to back off. The FCA issued letters to several banks accusing them of mistreating borrowers and abusing the bounce back loan scheme. And as a result of that, some banks have decided not to pursue court action and instead rely on the government guarantee to recoup the losses. But the banks like Barclays, Lloyds and Starling are taking a different approach. Now, if you're a director who took out a bounce back loan and you're worried about facing liquidation, there are some steps you can take. I mean, stay up to date with your filings. Don't give the banks any reason to suspect any wrongdoing. Make sure your company accounts and confirmation statements are up to date. Communicate with your lender. You know, if you're struggling, the worst thing you can do is ignore the situation. Engage with the lender, try and work out a repayment plan, or engage with the lender and say, listen, there's no way I can pay this. Maybe legal help is what you need. If you're at risk of a winding up petition, you need to speak with a professional insolvency advisor as soon as possible. They can either help you negotiate, outline what the issues are going to be in a liquidation, or potentially avoid liquidation altogether. Now, this forced liquidation scheme is a serious wake-up call for directors across the UK. If you've taken out a bounce back loan, especially if you've over-egged your turnover or used the funds inappropriately, you could be next. Like it was in the Labour manifesto, they are gunning for people who've misused the bounce back loan. Now, the best thing that you can do is to stay on top of your company filings, communicate with a lender and seek advice if you're in trouble. Thank you for watching me. If you found the video helpful, don't forget to like, subscribe and leave a comment. Protect your business and your personal assets before it's too late. My name's Chris Worden. Thank you.